day friends. In the subject of fundamental of investment, in the current series of lectures, I am talking of valuation of securities, and the two approaches we are discussing is fundamental analysis and technical analysis. And in my previous lectures, I talked about technical analysis and some of the indicators and some of the charts I discussed in my previous lectures on technical analysis. I am continuing with that, and I will be discussing some of the more indicators, the patterns that is being formed in the charts, on the basis of which technical analysts predict the stock price behavior, that is how the price will behave in future. Because as you know that the technical analyst tells you that technical analysis, by technical analysis we know that when to buy, when to sell, right? Fundamental analysis tells you what to buy, what to sell, but technical analyst, the job of a technical analyst is tell you exactly, to guide you that when it is a time to buy, when it is a time to sell, right? And technical analysis believes that history repeats itself, that is on the basis of past price behavior and patterns we predict about the future. So one of the patterns that the technical analyst, apart from the patterns in the graphs and charts which we discussed in our previous lectures on technical analysis, let me continue with those with the technical different charts and patterns, right? I mean, one of these head and shoulder pattern. What is this head and shoulder pattern? Head and shoulder chart pattern is the most popular among all the chart patterns. At the end of the long trend, especially a bull run, we may find a head and shoulder configuration. This pattern has a high top, that is the head, one is the head, and the two small tops on the either side which are called the shoulders. First let me show you the pattern, the chart. What you are noticing here is that on the top, what we have done is x-axis the price, the y-axis, x-axis the time, the y-axis the price, and by joining the closing price of a particular company's share, a pattern has been drawn, right? By seeing this pattern, you can know that at the top a head is being formed, and with the top the two shoulders you can observe here. Two shoulders are being formed, and on the basis of these two shoulders we have drawn a line which is called neck line, right? So one is head where the price has reached the top, and the two adjoining tops which are below the head is called the shoulders, and on the basis of shoulders we have drawn a line that is called neck line. So this pattern has a high top, head, and two small tops on either side, right, which are called shoulders. So one can draw a neckline by joining the bottom of the shoulders. So when you join the bottom of the shoulders, you get a line that is called neckline. So now what is the relevance of this head and shoulder? This comes in the picture, right? If stock prices goes below the neckline, it indicates bearish phase in near future, and hence a sell signal to the short-term investors, right? Friends, what the head and shoulder tells you, that once the stock price goes below the neckline, it's a sign that in the near future the price will go down further and it is a time to sell. Head and shoulder pattern shows you when to sell and what is the right time to sell. What time means when a particular share price reaches that level. What is that level? Neckline, below the neckline. So once it breached the neckline, it's a sign that the share price is in the bearish mode for the short term and is a time to sell. Reverse is the case, which we call it inverted head and shoulders. What is in the inverted head and shoulders? In the head and shoulder case, one top was being formed at the top and two adjoining shoulder top were being formed of the shoulder shape, and on the base of by joining the bottom of the shoulder we have drawn a line called neckline. In this inverted head and shoulder, it is just the reverse of head and shoulder configuration. Inverted head and shoulder pattern has an inverted head and two inverted shoulders. See, what you are seeing here is the bottom is the inverted head, and adjoining the inverted head there are two shoulders, and the shoulders, the top of the shoulders, we join these points and this is called a neck line, right? A faster line is being drawn here which is known as neck, which is called neck line. Once the share price goes above the neckline, it's a sign that the price will go up further, right? So if the stock price rises above the neckline, it indicates bullish phase for the stock in near future and hence provides a buy signal. Means once in the inverted head and shoulder, which is the reverse of the head and shoulders, the head and shoulders, the top is called the head and the two adjoining shoulders are being formed. If price goes below it, it will be a sign to sell the share. But in the inverted head and shoulders, at the bottom, a head is being formed and with the bottom, the two shoulders are being formed. And when you join the two shoulders, you get a line which is called neckline. And if the price goes above the neckline, it's a buy signal. Means the moment the share price breached above the neckline, it means in the inverted head and shoulder, it's a time to buy the share. It's a buy opportunity for the investors, right? Apart from head and shoulder, there is another pattern that is being formed, which we call is triangle, right? Triangles are being formed on the basis of the price behavior of the share. So there are three types of triangles which we normally study. One is called symmetrical triangle, which is made on the bottom. On the left hand side, this is ascending triangle, and on the right hand side, you can see descending triangle. So triangle pattern can also be detected in stock price charts. Triangle pattern can be of three types: symmetrical, ascending and descending triangle. First, let me talk of symmetrical triangles. Again, on the base of the stock price behavior, the lines are being drawn. And if you join the bottom of these lines and the top of these lines, right, you get a triangle which is of symmetrical shape. And if the share price breaches that symmetrical triangle, it's a sign of bullish phase. Bullish phase means bullishness in the stock. So symmetrical triangle suggests a range-bound market till it reaches completes. If the triangle is of symmetrical nature, first of all, I will say that it is a market where the market will be range bound. Range bound means it will go within a range. Say, if I talk of a particular share, I will say it will move around from say 300 to 350. From 300, it will go up to 350. Again, come up, it will start falling, come near 300. When I say 300 means approximately equal to, it may be 295, 297. So 300, it goes up, then again 350. From 350, it again falls, comes near 300, again increases, goes up to 350, again falls. Means it is roaming, it is moving between 300 to 350. That is called range bound market, right? So in a range bound market, it may be for the whole index, it may be for the particular share. So in a range bound market, the triangle that is being made is called symmetrical triangle. But if the line goes beyond the symmetrical triangle, it's a bullish sign. Means now, as you are noticing here in this, that in the last extreme right side, the line has breached the line of the triangle. So it means in near future, there is a bullishness in the stock prices. So it's a signal to buy the share. When ascending triangles breaks towards above, it suggests bull run in the near future and hence a buy signal. Means if the triangle that is being formed on the basis of the stock price behavior, so it's a sign that in near future the price will go up. The triangle that is being formed on the basis of joining the stock price of the past, the triangle, if it is a ascending triangle, it means the market is going up, and once it breaches the above line, it means the price will go up further. Reverse will be the case in case of the descending triangle. If descending triangle breaks towards below it, implied price declines in near future and hence suggest a sell signal, right? So on the right hand side, you can see the descending triangle, right? So in the descending triangle on the right side, if the line breaches the horizontal line that is being drawn in the descending triangle, right, almost horizontal line, so that is a sign that there will be further weakness in the market. So this means on the basis of the charts, a triangle is being made, and whether the triangle is going upward side, whether the triangle is falling, or whether the triangle is of symmetrical nature, right? On the base of that, we can say whether the market is going up or the share price is going up, going down, and whether it is in the range bound, right? And once, if the ascending triangle line breaches, it's a sign of further bullishness. If descending triangle line breaches the bottom, it is a sign of further weakness in the market. And if in the symmetrical triangle, if the line breaches the symmetrical triangle line, it is a sign of bullishness. So on the base of the triangles, the share price, the triangles are being formed, and by seeing the charts of the triangle, the price behavior of the triangle, right, that the triangle that is being formed on the base of price behavior, we can make out whether the price will go up or whether the price will come down. Now friends, after talking of these charts graph broadly, we have discussed by now that the different pattern, different charts which the technical analyst uses while making the assumptions, by making the predictions of the future price behavior, that whether the price will go up, whether the price will go, means whether the price is in the bullish phase, bearish phase, whatever we call it. But these technical analysis are also subject to certain limitations. It requires lot of expertise. It has some element of subjectivity of the analyst who is analyzing it. Different technical analysts, different studies, different charts, different graphs, and they follow different theories, and they have their own pattern, own assumptions about the share price behavior. So technical analysis is an important approach of security valuation, as it helps in identifying the timing of buy or sell decision. As I said in previous lectures also, that fundamental analysis tells you what to buy, but technical analysis tells you when to buy. What is the time to buy? What is the right price that now there is a sell signal or when there is a buy signal, right? And fundamental analysis tries to find out basically the intrinsic value of share, the fair value of a share. Technical analysis do not tries to find out. They say market is the best judge. That is, it is the market which judges whether the price is fair or whether the price is not fair, right? So we are nobody to judge whether the price is fair. In a bullish market, whatever the price may be, when the market is going up, according to the technical analysis, it is the market which decides the right price. It is not the individual those will decide that what is the right price. The person will decide the right price, right? So technical analysis, on the base of past price behavior, you can find out that price will go up or not. So it is based on a variety of tools, techniques, and trend analysis. Means there are different tools and techniques that we use, but technical analysis is based on analysis of past price and volume data. However, it suffers from certain limitations. What are these limitations? One of the important limitation is requirement of interpretational skills. What you do in chart patterns is that you draw the lines, and by joining the previous price behavior, you draw the lines. On the base of these lines, we in this very lecture I talked about head and shoulder pattern, reverse head and shoulder pattern, and various chart patterns we discussed. But analyzing the right time, that now this pattern has reached and this is the time to buy or sell, this requires interpretational skill of the technical analyst. So various charts and patterns of the technical analysis requires careful interpretation by skilled analysis. Hence, technical tool and indicators may not be used widely by common investor. What it implies is that it requires lot of expertise on the part of the interpretation, on the part of the interpreter, and the man who interpret, the person who interpret these charts and graphs, right? That by using, sometime you use your past experience, and by using your past experience, you study these graphs, these patterns, and then you analyze it. So every common man, say there are like in fundamental analysis, there are certain common indicators. Common indicator like earning per share, book value of a share, what is the growth in the sales of a company, what is the growth in the profitability of the company, right? And these indicators are well-defined indicators, and on the basis of that you can judge whether the price is undervalued, or the share price is undervalued, or share price is overvalued. You analyze this company's earning per share, the book value, the growth in the sales, the growth in the profitability, the balance sheet, the cash flows. I mean, these are the various important indicators, the various ratios which you find, profitability ratios, right? And the solvency ratios, and various ratios are being used, and by these ratios are exactly being calculated. There is a particular science on the base of which these, earning per share, price earning ratio, the book value is being calculated. So there is no element of subjectivity in it. There is no element that the personal, it is on the basis of exact data, you calculate these ratios, you calculate these EPS and price earning ratio, and so on and so forth, right? But in the technical analysis, the graphs that is being formed, the charts that is being formed, how you read these charts, this depends on the interpretational skills of the individual, right? So it requires lot of expertise for reading these charts. When you are able to read these charts properly, then only you will be able to interpret these charts properly. So what it means is that it requires lot of expertise on the part of the technical analyst or on the part of technician to study these charts and predict about the future price. Means, when I say price, means the prediction about the buy or sell, whether to buy or sell. So as I was saying, it requires lot of expertise. When you read, when you study the technical charts and the graphs, there is a lot of subjective analysis and behavioral biases that comes while you read the charts. There are 5 different technical analysts who are studying the same chart. They may interpret that chart differently, right? Because there is an element of subjectivity in it. So technical analysis are subject to many behavioral biases while interpreting various charts pattern and predicting future stock prices based on the analysis of past price data, right? Some of these behavioral biases are overconfidence. A technical analysis has a lot of confidence in a particular share because of various past experience or like that. So that person has an experience that every time when it reaches a particular bottom, it forms a double shoulder, right? The double bottom, once the second bottom is being reached, again the price will start rising. The various charts which you have studied, the various graphs which you study, on the basis of your past experience, that you are very optimistic and you give a particular signal to buy or sell, right? So sometimes there is a overconfidencing, there is a framing. Framing means within the frame you want to see it. There is a regret avoidance and so on. So there are various subjectivity analysis, subjectivity element that is there while studying the charts, while studying the graphs, right? So while studying the stock price behavior of the past. So one should always keep in mind that when technical analysis suggests something, it has an element, it can be having, I'm not saying it will always be there, but it can have an element of subjective analysis and behavioral biases. The other important limitation of technical analysis is late response to a chart pattern. See, in technical analysis, time element is very important. Reading the chart at the right time, indicating the buy signal or the sell signal at the right time, at the right price is very important. Once you lose the bus, it will be difficult because then the price will reach in a different zone. So if you respond, responsiveness is required on an immediate basis. So if you are not able to respond on an immediate basis, the very purpose of making technical analysis may be defeated. So once a chart pattern is detected, it needs to be acted upon immediately. Because one of the reasons may be, I would say, that technical analysis is by and large being used by short-term traders. Fundamental analysis is by and large being used by the long-term investors, the people who invest for a fairly long period of time. It may be 3 years, 5 years, 10 years, right? Or even 1 or 2 years, means fairly long period of time. Technical analysis is by and large being used by the short-term traders. There are a whole host of people, investors, I would say not investor, I would say people in the stock market who makes intraday trade. Intraday means trade within the same day. They buy on a particular day and sell in the same day, right? So by just finding the difference in the prices, they want to make profit, right? So when you are an intraday trader and you are using the technical analysis, which is normally being used by the technical analyst, which is used by the day traders. There are day traders, there are positional traders. Positional traders are traders who trade for 10 days, 15 days, 20 days. They buy the share, right? Either they will sell on the same day, or they can hold the share for 15, 20, 1 month and sell. Means they trade for a very short period of time. So these people who trade for a short period of time, right, whether they are intraday trader or whether they are positional trader. Positional traders are traders who purchase on a particular day and keep the share for some time, say 10, 15 days, 20 days, 1 month, right? So these type of traders are called positional traders. So these positional traders or the intraday traders must read the chart pattern and must respond instantly, right? Then only the benefit of the technical analysis will be made to them. So once a chart pattern is detected, it needs to be acted upon immediately. Hence, the technical analysis must be a quick identifier of a chart pattern. Means the person who makes the technical analysis must understand the chart pattern immediately to make gains out of it. In practice, such a quickness or promptness is, not very often, quite often being observed. I will not call it a rarely observed, but I will say not everybody can immediately show this promptness. So these are the few weaknesses of the technical analysis. Apart from that, one of the other weakness which I discussed while talking of this late response to chart analysis is the short-term perspective. These technical analysis have a short-term perspective, means normally the technical analyst analyze for a short period of time. Mainly it is being used by the intraday traders, positional traders, or people who invest in the stock market not for a long period of time, for a short period of time, say 4 months, 6 months, 3 months, like that. So the respective of a chartist is short term, and the perspective of a chartist is short term, and hence long-term predictions are generally not based on technical tools and techniques. Means long-term predictions for 5 years, 10 years predictions are by and large being made by fundamental analysis. But let me caution you here that fundamental analysis and technical analysis doesn't mean they are two exclusive things. They are complementary to each other. Means people complement people. Who makes investment in the market. They see the fundamental analysis and also see the technical analysis. So they are complementary to each other, right? So for long-term analysis, fundamental analysis is a better approach to find out the real worth of the share. Means the perspective of the technical analysis is short-term. So friends, this is all about your technical analysis and the different chart patterns we discussed, and in the end we discussed the limitations of the technical analysis. So we studied the fundamental analysis and technical analysis, which are the two approaches of studying the valuation of the financial securities, or if I call it specifically, of the equity shares. After talking of the fundamental analysis and technical analysis, let me talk very briefly about the principles of sound investing. Right? Means when you invest, there are certain principles which must be kept in mind in equity shares. Whenever you invest, you must keep in mind certain principles while investing. So investment should match with an investment objective. Whenever you invest in the equity market, whenever you invest in the equities, you must have a clear goal why you are investing it. You will say that I am investing so that I can make profit, I can enhance my investment, I can increase my income, right? This is a by and large objective. But what exactly is your objective? Like say for example, if a young couple got married, the young couple wants that by the time their son or the daughter, I would say the daughter, will become 16, 17 years and she will go for the higher education, they must have a X sum of money, right? So your objective is after 17 years, you must have 50 lakh rupees or 20 lakh rupees for your child's higher education. That is your objective. Your objective can be you want to take retirement in the age of 55 right? You start making earning in the age of 25 and you want that you will in the age of 55, I must get retire, means I must have that much corpus so that after my retirement, I can use that money for my future expenses, right? So that is your objective. So investment must match with the investment objective, right? So your objective is that in the age of 55, you are 25, means after 30 years, you must have that much corpus, say you must have 5 crore rupees. So for investing 5 crore rupees, that what investment strategy you will adopt? Certainly you will invest for the fairly long period of time. So that should be clear in your mind. And keeping that strategy, keeping that objective in the mind, you must invest. Supposing I want that after 3 months I have to buy a car. And for buying a car I require 15 lakh rupees. Sorry. So I'll make in my investment not for very long-term securities, not very securities which will go up in the long run. I'll read the technical charts, I'll read the technical analysis, make the technical analysis, and on the base of that, I'll predict that within 2-3 months where the stock prices will be. And on the base of that, I'll make my investments. The other very fundamental principle of investment is called diversification. As a general phrase says, that do not put all your eggs in one basket. Similarly, even if within the equity, or I would say the general rule is that you must invest in different asset class. That is, asset class means fixed income securities, the equity shares, the real estate, the gold. There are different asset class, right? So the investment should be diversified. If I stick myself to equity, don't invest the whole money investment. You want to invest 10 lakh rupees. Don't invest all the 10 lakh rupees in one equity, one company. Invest in 5 different companies, right? So diversification and of different industry. Not if you put, all your 10 lakh rupees in one industry. Supposing you put in, say, steel industry. Steel industry is a cyclical industry. The nature of the steel industry is of a cyclical nature, right? Steel prices are affected by the international prices. Suppose it's in a downward cycle. It comes to in a downward cycle. Then your steel prices, the price of steel will not go up. So the share price of steel companies will not go up for 3, 4, 5 years, right? If it is in a downward cycle, and normally the cycle is of 4, 5, 6 years, right? So you will find that your share prices are not going up, right? Rather it is falling. You will get disturbed. So better strategy will be that some of the investment in the steel industry, some of the investment in the IT industry, some of the investment in the textile industry, some of the investment in the banking sector, and so on and so forth, right? So there must be diversification while making investment. So when one investment performs badly, the other should be better to compensate losses. The other important consideration is tax consideration. While making investment, you must see that what is the after tax return. Different people are in different tax brackets. If income having up to a particular limit, the person may not be in taxable bracket. So that person's decision whose income is not taxable, the investment strategy will be different than a person who is in the higher tax bracket. Say for example, bank fixed deposits, right? Bank's fixed deposit gives 5.5% return these days, around. But if it is the person is in the 30% tax bracket, so this 5% interest, the income that will be accrued on his investment, it will be further subject to tax of 30%. On the other hand, if you keep equity share for more than a year, as per the present direct tax laws in India, your income will be tax free, provided you make a gain of less than 1 lakh rupees. He is a small investor. The person she is a small investor. So if the income is if the capital gain is, and if you hold the share for more than a year, it comes to be long-term capital gain, right? So up to 1 lakh rupees, long-term capital gain is tax free, right? Up to 1 lakh rupees. So you must see that what is your tax bracket. So what is the after tax return, right? So tax consideration must be an important indicator while making investment decision, right? Hedge against inflation. Whenever you make investment, you must see that your return should be greater than the inflation. Otherwise, your value of your money will lose. Suppose the inflation rate is 5%, and the bank, or if I put it, say the inflation rate is 7%, and if the bank FD gives you 5%, it means value of your money is not increasing, rather it is decreasing. After 100 rupees, if 100 rupees will become 105 after a year, but the real worth of that 105 rupees will not even equivalent to 100 rupees after a year, since inflation has taken place in a year to the extent of 7%. So, whichever investment decision you take, you must see that it is hedged against inflation. That is, it should get a return which is higher than the inflation rate. And lastly, I would say power of compounding. That whichever investment you make, your return on investment should also give you further return. That is, if I earn 5 rupees on an investment of 100 rupees, this 5 rupee return or interest income should also give me additional income in the next period. This is called power of compounding. Power of compounding is a very important principle of investment, and young people should invest at the right time, so that in the time of 25-30 years their money grows at a very faster rate, and it will become a huge sum of money. You will have a huge corpus at the end of your life cycle. In the sense, end of life cycle means when you will get retired. Working life cycle, I would rather put way. So these are the broad principles of the investment. So thank you very much.